you come up with $50,000 gold. Now, this is just little by little, day by day, bit by bit, but this criminal price suppression actually is the great opportunity that has been provided to the precious metals investor. They are losing control, and as they do, the price will explode. This is the metaphor of pushing down on a spring, and when you lose control, it's going to bounce a lot higher. And so this criminality from them is your great opportunity.
It is very tough to come up with a bear case for gold. Of course, global recession fears could push gold a little lower if we see really an impact there. But what could change the thesis here? It's world peace. Don't see that happening. We've just seen Russia and Poland clash last night.
Yeah.
World peace is off the table. What else is there? The U.S. debt situation is not going away. We got $340 trillion in global debt. Central banks are still buying gold because they don't believe in the SWIFT system anymore. We might see massive monetary change.
The global gold market appears to be at a significant turning point, one defined by the exposure of long-running price suppression and a massive shift in institutional sentiment. The evidence is mounting that artificial mechanisms have held back gold's accurate valuation for decades. But as central banks around the world increasingly reject Western-controlled financial systems and unwind paper-based gold contracts, those constraints are beginning to fail. What's emerging is a two-tier market, one for real, physical gold and another for the synthetic version traded through Western exchanges. When that imbalance finally breaks, the physical market could reprice dramatically higher, exposing just how undervalued gold has been all along. MikeMaloney, a longtime educator, investor, and author in the precious metals space, and KaiHoffmann, founder and managing director for SOAR Financial Partners, explore how the manipulation of gold prices, particularly through the London Bullion Market Association, has inadvertently created one of the most significant wealth opportunities of our time. They point to data showing that if gold traded freely outside of London's hours, its price could already be above $50,000 per ounce. Meanwhile, major banks such as JP Morgan and Morgan Stanley are now publicly endorsing gold and silver allocations, marking a significant shift in institutional thinking. With massive gold lease unwinds, central bank accumulation, and cracks appearing in the fiat-based system, this may be the final phase before gold breaks free of artificial constraints. We're witnessing history in real time, the unraveling of decades-long price control and the re-emergence of honest money. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
This is from Nick Laird at Gold Charts Are Us. I've been instructed by the ICE that I am not allowed to display the LBMA gold and silver fixes upon my website as I don't have a license. Here is the ICE. It's the Intercontinental Exchange. That's where the LBMA prices come from. Why would they hide these? Well, if you are being caught committing a crime, if you're being charged with a crime, the very first thing you do is you gather up all the files and you head to the paper shredder and you shred them all and get rid of the evidence. Well, that's what they're trying to do, is get rid of the evidence so that people like Nick Laird can't do this great investigative reporting. This is just math. The red line is the price of gold. The black line is the price of gold if only the London hours were traded. In other words, from the AM fix throughout that trading day to the PM fix, if that was the only trading that goes on, and then you paste that to the previous night's close of the London trading only, what you end up with is gold went from 1971, it was at $35, and today it would be $2.24. If you only take the trading at the close of London when the rest of the world is trading, and you take those hours, the percentage change in price during those hours, and you paste it to the previous day's close of the percentage change of non-London trading hours. Everybody else in the rest of the world, you come up with $50,000 gold. Now, this is just little by little, day by day, bit by bit, but this criminal price suppression actually is the great opportunity that has been provided to the precious metals investor. They are losing control, and as they do, the price will explode. This is the metaphor of pushing down on a spring, and when you lose control, it's going to bounce a lot higher. And so this criminality from them is your great opportunity. Luke Groman, I want to thank Luke for this wonderful chart. The red line is the S&P 500. The blue line is the S&P 500 priced in gold, and the S&P 500 has lost 21% since August 15th, 1971. It's down 21% priced in gold. Let me see. Gold is more than $1,000 higher. We're in the 26s. It's $1,100 that they protected you from making on profit, which is a 45% return over that same time period. So, Geiger Capital. Gold stopped tracking U.S. real rates in 2022, and this is the 10-year Treasury inflation-protected security, the TIPS, so inflation-protected U.S. Treasuries. And it's a little bit different than the 10-year minus inflation, the real rates. But look at the correlation here between the price of gold and the 10-year inflation-protected Treasury. The correlation up to here is probably something like 0.97, 0.98. So 97, 98% the same. And then this divergence in 2022. Why? In 2022, the U.S. decided not just to sanction Russia for the invasion of the Ukraine, but to seize Russian assets and reserves. And that put all the world's central banks on notice that that America has become this lawless country, just basically violating the rules of the international monetary system and going ahead and seizing another country's assets just because we don't like what they do. This is the 10-year real rates versus gold. So it's the 10-year minus, and it's a little bit different. You didn't see this big dip in the other chart, but still the correlation is mind-bogglingly huge. And then this sudden divergence at the beginning of 2022. And what is very interesting is the spot gold versus total gold ETF holdings. It's not the beginning of 2022, but the end of 2022, beginning of 23, it diverges. And the correlation here is just absolutely spot on. And that means that it was the West driving the gold price back then. But something changed, and it is no longer the West. We've been dishoarding gold. We've been selling, while the rest of the world, somewhere else, central banks, including the rehypothecation, the dehypothecation, the unwinding of all of those gold leases might be part of this. I have no evidence, not saying that it is. I'm saying it's a theory. It might be part of the rise in the gold price, because as you unwind these things, there are fewer and fewer ounces of imaginary gold out there. And as you have fewer and fewer ounces in the same gold market with the same amount of cash in it, the price has to go up. And so I just find it interesting that these charts are all diverging at about the same time. And Spencer, Spencer says, the dollar has lost 50% of its value versus gold in the past 3 years. 50%. Understand where we are. You now live in a third world country. And boy, is he right. Just a few days later from Correlation Economics, JP Morgan knows. And this is their recommendations for your portfolio by asset class: equities, bonds, credit, currencies, commodities. Long gold, silver, and platinum. Platinum, I'll get to that in a minute. Short oil and base metals. Now, if you're going short oil and base metals, you think that there's some bad times coming in the economy. You think that there's going to be less demand for oil, less demand for base metals. Base metals is what you build cars, and houses use copper plumbing and wire and all sorts of things. So this means an economic slowdown or even a depression. This means crisis, long gold and silver, that this is where you want to protect everything. Platinum is a commodity. It's an industrial metal. It's basically a catalyst. In your catalytic converter in your car, there's platinum or palladium when platinum becomes too expensive. But platinum has never been money. It isn't money now, and it will never be money. Gold and silver have been money and the safe haven asset for 2,500 years. And when there's a crisis, which shorting oil and base metals says that they are expecting, people rush toward precious metals, gold and silver. Not platinum, not palladium, not rhodium. They rush to gold and silver. So long gold and silver, I just don't understand why they would recommend platinum. Moving on. I used this in my silver update, but Bald Guy Money, I reported on this 2 weeks ago. The one that I was using is the one that he reported on 2 weeks earlier. The 60-40 portfolio is headed for the guillotine. A 20% allocation would blow all my forecasts out of the water. I was calling for an 8% allocation, which is 20% of the 40%. But what they want here, so this has the potential to be huge. No, way beyond huge. Astronomical. I mean, this is like light years stuff. Morgan Stanley CIO favors a 60-20-20 portfolio. So Morgan Stanley is recommending getting rid of 50% of your bonds. This is normally 60-40, 60% stocks, 40% bonds. Get rid of half of your bonds, 50%, instead of 20% of the 40%, and get rid of half of your bonds, 50%, and that 50% you allocate to gold, and you end up with a 60-20-20. The bond market is one of the biggest markets on earth. This is just absolutely astronomical. This is breaking news from Gold Telegraph. Freeport-McMoRan has declared force majeure on contracted supplies from its Grasberg block cave mine in Indonesia. Wow. Okay, this mine has one of the largest reserves of gold and copper in the world. Now, so there's less supply coming to market. Normally, a big company like this, Freeport-McMoRan, what they would do in a situation like this is they would go to a central bank and they would lease gold. And I want to thank Brian London, the CEO of the New Orleans Investment Conference, which I'm going to get to in a minute, for this thing. He says, probably nothing. Peak administration mentions of the Fort Knox audit, and then radio silence as gold goes through the roof. Well, they are it is a fact that central banks lease gold. All of the American gold, except this tiny little sliver that's it's not even 1% of the gold. It's still held by the Treasury. All of it has been rehypothecated. It's been the title has been given to the Federal Reserve, our central bank. The Federal Reserve owes it back, but then they have rehypothecated it, and it's been rehypothecated and rehypothecated, and so it keeps on getting lent out on contract after contract. But normally, they would go and lease gold from a central bank and deliver the gold that is contracted for and then pay it back later, and they pay a couple percent interest. And so the central bank gets to make 2% interest on that gold. Well, if they are in right now trying to unwind all of those gold leases that they've done, that would cause the gold price to rise, and it would be a good reason for this radio silence, basically.
Gold's relentless momentum has caught nearly everyone's attention, with prices pushing well beyond expectations as multiple macro forces converge. The combination of a weaker dollar, rising global debt, and persistent geopolitical instability has reignited investor demand for hard assets. Central banks remain aggressive buyers, solidifying gold's position as a reserve asset outside the Western financial system. The most telling sign, however, is the return of ETF inflows in North America and Europe, a clear signal that institutional capital is flowing back into the metal after years on the sidelines. Retail trends echo this sentiment. Vault operators report strong physical demand, with many investors liquidating earlier positions for profit while others accumulate more aggressively, anticipating higher prices. With gold hovering near record levels, producers are enjoying exceptional margins, even as rising energy and labor costs begin to pressure operations. Yet despite these challenges, few can construct a convincing bear case. The global debt burden, deteriorating trust in fiat systems, and ongoing geopolitical flashpoints keep gold's long-term trajectory firmly intact. In short, we're entering a new phase of price discovery for gold, one defined by structural change rather than short-term speculation. Let's get back to the interview.
I'm excited about gold moving. It's a massive move, of course, maybe a bit too aggressive almost, but again, momentum. That's what it comes down to. People are jumping into it now. We're at 36.50 as we speak. A lot of factors going into it. You discuss it ad nauseum on your program as well. Geopolitics, debt situation, weaker dollar, and just overall sentiment towards gold and precious metals, central banks buying around the globe. So nothing new that I can add to the discussion here, but all those factors combined have just moved so much. And now we're seeing ETF buying again as well. As of August, I think World Gold Council just reported August, we've finally seen some inflows again into the ETFs in North America and Europe. Asia surprisingly selling a little bit, but that is positive as well. So there are a lot of factors that just added together, and it's really difficult to come up with a bear case for gold right now. Like I was recently at a gold depository, and they buy and sell gold and silver from retail investors, and they've actually seen more. They had to buy more gold and silver from their clients than they were selling in August, which is an interesting indicator. It could be a recession warning. It could be people just taking profits because they bought during COVID. They bought a lot of physical at say $20 an ounce, and now they're selling at 40, so an easy double for them. But going up alongside stocks, there's a liquidity thing as well going on. Like we had a lot of liquidity in the market. Some of that has shifted to gold, but it's just that blow off top that we're in. Like bad news is good news for gold and the stock market. So QE is great for the stock market because that means cheaper money to invest and yields. You can make easier returns, but it also means that lower interest rates also is great for gold because we all know gold doesn't yield anything per se.
Right.
So it works really well in tandem. The margins didn't prove to be consistent at that point, even for the higher higher optionality plays. People didn't believe it. And it took until like this year, until a new president in the White House, a lot more uncertainty, a lot more geopolitical conflict to really push us in that direction, of course. And that's what we're seeing now. The reality is starting to set in. Of course, margins, in my opinion, will start to shrink slowly again because prices will move up. Every producer, if you look at, or every service provider that works with the producers, looks at the gold price, say, wait a second, you're making $3,600 here, but I'm only charging you X. I'm going to start increasing my prices. Oil can't be staying at $60 a barrel for forever. So that'll eventually add on to the margin.
What's the biggest cost item for producers?
Energy and people, right? So at 3,600, people will start to demand higher wages at some point, right? And that is starting to creep in. And as long as the gold price keeps rising, that shouldn't be a problem, but we'll see higher all-in sustaining costs. It is very tough to come up with a bear case for gold. Of course, global recession fears could push gold a little lower if we see really an impact there. But what could change the thesis here is world peace. Don't see that happening. We've just seen Russia and Poland clash last night. World peace is off the table. What else is there? The U.S. debt situation is not going away. We got $340 trillion in global debt. Central banks are still buying gold because they don't believe in the SWIFT system anymore. We might see massive monetary change, but I'm really having a hard time for it. There's certain like recession, stagflation indicators. Like if the market tanks, all of a sudden gold will also be hit, but that'll be temporary. Gold needs to be stored somewhere and they need to have access to it to just lend credibility to what they're doing, right? So is it China? Is it anybody else? Is it Russia that's using silver? Who knows? Because it's the only tangible asset that can't be taken away. That's a true store value. It's not Bitcoin. It's not anything else. They can't just buy farmland in the US and bank against it. That just doesn't work. It's the only real money. I think we're going to see stable margins because I'm assuming gold will stay around $3,600, $3,500 gold. So I'm assuming stable margins, maybe actually margins decrease just a little, and I'm being overly negative here. But we're still seeing the market trying to understand the margin expansion that we've seen. So we're still catching up. Q2 was a $3,300 gold roughly weighted. We'll see again higher prices on the average for Q3. Where are we at? Probably 3,500 at volume weighted average price here for gold, which is absolutely phenomenal. That's another $200 on top the margins we've seen last quarter, and that will trickle down into the share prices. Margin expansion is the key here, and that will somewhat continue. I think it will stabilize though, unless we see massive event in gold that'll push it maybe to $4,000 or $4,500. But I'm quite happy with where we're at. I'm starting to sound greedy here or overly negative, but I'm happy with where we're at. Higher gold prices triggers more investment. Gold is always leading the other sectors as well, even silver and copper to a degree. You can pick up some trends like in lithium, uranium. You can see more of those deals pick up, but there's usually something that happened on the macro side that triggered that. Copper is still digesting the shock that we've seen from the tariffs impact. It dropped 25% in a day. We're slowly creeping out of that hole. Silver's done okay, although it's struggling to break out of that resistance at $42. It is stuck there. It has some catching up to do. Actually, gold-silver ratio is increasing ever so slightly as we speak right now, sitting around 88 and a half. Gold has been outperforming. Silver, I think, is still still attached to the industrial demand. Still 50% of that is industrial, so maybe that is holding it back versus gold right now. But year-to-date performance has also been stellar, but it hasn't outperformed gold.
Gold's current trajectory reflects a more profound shift in global confidence, not just a speculative rush, but a reassessment of value itself. With ETF inflows returning to Western markets and central banks continuing to accumulate, gold is reclaiming its historic role as a monetary anchor in a world that's rapidly losing trust in paper promises. The combination of liquidity rotation, geopolitical instability, and debt saturation has created a perfect storm that's driving investors toward hard assets once again. This is not a moment for emotion or hype, but for clarity and preparation. The gold market is sending a message about where capital safety truly lies, and those who understand it early will be well positioned for the decade ahead. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.